over a long period of time, the difference between money that is not working for you and money that is working for you is gigantic. Yeah. It's called compounding.
Do you want $1 million or do you want 360K in 30 years? Our guest today is Michele Ferrario, previous CEO of Zalora, Asia's leading online fashion destination. Now the mastermind behind StashAway, the first digital wealth platform in Southeast Asia with over $1 billion in assets under management.
If you make small bets, you might be lucky, you might not be lucky. If you're talking about 5% of your money, that's fine. It's play money. But if you're talking about your retirement plan, that's not fine. Don't look at the markets, diversify, invest over time, dollar cost average. Whether the markets are up, down, right or left, it doesn't matter. The problem is that you don't see it next month. You don't see it the following month. You don't see it in 5 months from now. We seek instant gratification. We don't have the intrinsic motivation to actually have this long-term goal and keep at it.
Can you spill the beans and tell us what are the few key principles that new investors need to understand?
Yeah, so look, the way I think.
So, Michele, welcome to the podcast.
Thank you for having me, Kevin.
How are you doing?
I'm good. All good. It's been a interesting 2023. Good start of the year.
What's been interesting about it?
I mean, from a professional perspective, as you know, as the co-founder and CEO of StashAway, I manage an investment platform. And therefore, I look at markets, global markets, equities, bonds, and whatever else, quite often. And 2023 has been quite interesting so far because most people were expecting a negative start of the year. In reality, it's been quite positive and driven by just a few stocks. So it's been quite interesting.
Where do you think we're going? Because actually, it's true. Even now, there is so much fear about the next big crash. This time is different. This debt deflation, and it's not only often we have in investing there is all the market commentators, people that usually you do better when you go against the crowd. But this time we even have Stan Druckenmiller, one of the best investment manager of all time, who is actually very worried about what's happening. So what's your take? I mean, obviously, no one knows, but what's your take on?
My take is nobody knows. And therefore, my take is that you shouldn't think that you know. And
what do you do when you don't know?
What you do, what you don't know, is you do the right thing. And the right thing is to don't look at the markets, diversify, invest over time, dollar cost average. Whether the markets are up, down, right or left, it doesn't matter. You just keep investing in a diversified portfolio. You're not making small bets. Because if you make small bets, you might be lucky, you might not be lucky. And you only know after the fact. And if you're talking about 5% of your money, that's fine. It's play money. But if you're talking about your retirement plan, that's not fine.
Yeah. So you do the old, boring, unproven methodology.
Exactly. And, there is one of my favorite quotes. I actually don't know who said it, but one of my favorite quotes on investing is that investing should be as exciting as watch grass grow.
Okay. I hear the one where it's very similar. Investing should be as watching paint dry.
I also know that one. Yes.
Yeah.
Watching grass grow or watching paint dry. That's the definition of investing. And I agree with that. The problem is that because that's boring, the industry around it has built excitement. And how do you build excitement? You build excitement by saying, okay, today buy this and tomorrow buy this other thing. And most of the industry makes money out of transaction.
100%.
So the industry makes most of the money out of making you buy and sell stuff, whether it's funds, whether it's stocks, whether it's whatever it is, right? And that you don't make money, but the industry makes a lot of money. And that's what you should not be doing.
And then you couple that with our generation where we're living in this instant gratification world, this social media world where we are basically all these dopamine hits everywhere. And we need, not only we don't like the boring, but we love and we need the kicks and the highs, and therefore buying the latest meme stock or shitcoin or is exciting. And even if we end up losing money, we actually take the whole thing as a big joke. You know?
But it's very human. Look, let's look at what's happening right now, right? So, as I guess the stock of the year is NVIDIA.
Yeah.
Cheap manufacturer, and I don't know the exact numbers, but the stock grown by more than 100%. I don't know exactly the number over the course of the last few months. And it's very human that as you read it, you're like, oh, wow, I wish I would have bought and I would have put all of my money in NVIDIA in January, and now I would have doubled it.
Yeah.
Instead, I put in this diversified portfolio and I only made 6% or 8% or whatever that is, right?
Yeah.
And that's very human.
Yeah.
Now, when... And I don't know what's going to happen to NVIDIA. Maybe it's going to, dominate the world, and
because this makes sense, at least with the AI narrative. There is a shortage of chips, and absolutely,
I'm not
there is an underlying narrative that makes sense. That is not it's tied to something.
Yeah, I'm not sure the price makes sense, but let's not go there.
Yeah.
Let's not go there. So, but let's say I don't know the future. Whatever happens. So let's say that at a certain point, NVIDIA actually, reduces its price because the price drops a little bit because it's very kind of expensively priced right now, and then you don't read it as much in the papers, and so you forget about that, and so your human instinct, oh well, I missed that, next time I'm gonna try to jump on the next train. Unfortunately, human biases make all of us terrible investors, and that's why, as an investor, you need to build framework systems, logics that kind of constrain you from those biases. For instance, one product that I think it's horrible in the industry, but actually probably helped a lot of people do something right, is those insurance products with very long lockups, right? So these are horrible because the fees are
crazy,
super crazy, right?
Yeah.
And the fees are crazy. They invest for a long term. They probably take less risk than you can as an investor when you think such a long term investment. So when you look at net returns, they're horrible. These are people call them ILPs or any type of insurance linked to investments, and there are several sorts.
Yeah.
But if I have to say one positive things about these products, that the fact that they lock people up for 20 years, 30 years, they kind of force people to do the right thing. Now, do I believe that that's the right way to help people? No, of course. In fact, we build StashAway the opposite way, where you can withdraw money tomorrow. You can invest today and withdraw tomorrow. But then we encourage you not to do it, and we encourage you to continue to invest like if it was locked, because that's the right way to do it.
Yeah, so the contradictory thing is for these insurance products, which, by the way, in some countries, I think are even kind of by law, you need to do some stuff about that. So the entire industry is actually helped by the law. But anyway, the contradictory thing is there's so much fees. We'll talk about that later, the fees and all that stuff. So the compounding of the interest and the fees. So it goes in both sides. Because of these fees, people, if they understood the long-term investing and they would just buy an S&P 500 or whatever index fund, or use StashAway, they would do much better. But because of their psychology, even with all these fees, they're still doing better than if they're doing the thing alone, because they're just screwing themselves with their own psychology.
Yeah, because you buy, sell, yes, of course. And because you end up, and then if you follow your emotions, so your emotion will push you to buy high and sell low.
Yeah.
And because when markets are higher and higher and higher, you read about it, your friends talk about it, you open your investment app of sorts, and you see that you are in the green and everything is going well. It's like being at a casino and winning. Yeah. It's very difficult to stop.
I'm going to win forever.
Exactly.
And I love the kick. Yeah.
Exactly. While on the other side, when the markets drop, it feels like it's never going to stop dropping. And then you hear stories of, oh my God, these things are just getting worse. And the newspapers make it even worse because obviously they need to sell the newspapers. And so the human bias will make you, sell at the end of March 2020, the bottom of the markets, and buy at the end of 2021 at the top of the markets.
Yeah.
And that's a recipe for disaster. I'm not saying...
Especially when you repeat it over and over again, which we all do.
I agree. So ideally, you should do the opposite, which is, buy in March 2020 and sell at the end of 2021. But that's very, very difficult, if not impossible. So your second best strategy is buy in March, buy in April, buy in May, buy in June, buy in July. Close your eyes, don't look at the markets, diversify. And, 20 years down the road, you're going to pat yourself in the shoulder and have a very nice retirement.
Or kick yourself in the nuts because you haven't done that.
Yeah, no. But
which is what most people did. Yeah. So let's start just with a bit of your background before we go into all this conversation. We'll talk about obviously investing and a bunch of other really interesting things. What are the key few defining moments in your life that led you to being here today in this studio, sat in front of me as the co-founder and CEO of StashAway?
That's a profound question. I need to think about it. Let's actually go chronologically. I would say I was a good student at university. I think that's actually was a key thing, which I think some people underestimate. I joined McKinsey, which was a great platform to learn and a great brand that allowed me to then have more opportunities after that. Through serendipity, so this is maybe through serendipity and a former colleague of McKinsey, I joined Rocket Internet. I founded the Italian office of Rocket Internet. And that it's important because it was my step from professional world of consulting and private equity, which is where I spent the first half of my career, into the more entrepreneurial kind of internet role, so building new companies. And then fourth, when Rocket asked me to move to Singapore, because otherwise I wouldn't be here, to kind of become the CEO of Zalora, because that's why I'm in Singapore today. So these are maybe, so being a good student, I think is paramount importance, because otherwise, all of the following events would have not happened.
Especially the first one.
So yeah, so being a good student, McKinsey, Rocket Internet, and then Zalora for kind of the Singapore component. And then so that's maybe the professional path. And then obviously what's missing here is meeting my two co-founders, Nino and Freddy. That's obviously was key in then deciding to start StashAway. If I didn't meet them, StashAway would not exist. So that's obviously the key then decision-making point. And from a personal perspective, I guess maybe three parts to it. One is I grew up in a family where my father traveled a lot for work. And so while I grew up in Italy, and that's it, like I grew up in Italy, somehow I grew up with a bit of an international mindset, even if I was always in Italy. And I think that was driven by the fact that my father was traveling and he spoke good English, for an Italian of his age, was actually outstanding English. And I guess that somehow influenced the way I thought about what was the area I could play in. It was not just Milano or Northern Italy or Europe, but it was more global. My father used to come to Asia very often for work. And that I think had an impact, I guess, somehow psychologically. And then as a part of that, he actually enabled me to spend some time abroad. When I was like 18, 19, I spent a couple of months, 1 month every summer for 3 summers in doing internships abroad.
Okay.
And that I think was instrumental.
That's very smart, actually. The younger you do it, the better.
Yeah.
Yeah.
No, it was great. I mean, the first one, let me tell you about this. The first one, I was 18. And, I grew up in a small village in northern Italy of 4,500 people. And I used to go to the local high school in a nearby village of, 6,000 people or 7,000 people. And then, and then my father said, hey, do you want to spend July in, this was the last year of high school before university, the end of it. Do you want to spend July between high school and university in New York? There is this kind of person I work with that told me that,
Amazing.
If you want to go there, you can, do an internship there, for free, of course, right?
Yeah.
And so, I went from this like 4,500 people village, waking up in the morning with the breakfast ready because my mom was preparing it and, everything, to, oh my God, I'm by myself in New York. I'm going to work in the morning. And at 18 years old, and I think those experiences really changed the way I think about many things, made me, responsible faster, I guess.
Yeah.
And so this was important now, but I'm going maybe too deep on this. So let me kind of go back. You were asking defining moments. So definitely kind of growing up in a family where there was some sort of international exposure, and this played a big role. And then two, the fact that then also professionally, I kind of traveled a little bit, with McKinsey, and then went to do my MBA in the US, etc. And then Rocket obviously, brought me elsewhere. And then lastly, obviously I met my wife in the period I was back in Italy actually for a few years, and that's when I met my wife. And she's Italian, also kind of grew up in Italy, with actually maybe less international exposure than I had growing up, but somehow very open to explore. And so when the opportunity to come to Singapore came about, we were just married, no kids at the time. And she was a lawyer in Italy at the time, and she actually had the courage to say, hey, I'll drop my job as a lawyer. Let's try this, which obviously takes a lot of guts and a lot of trust in me, and also a lot of, trust in us as a family. And so we moved here, and what used to, was supposed to be a year, and now it's been 11.
That's what we hear a lot, actually.
Exactly. Now it's been 11 years, but obviously it wouldn't have happened without her and without her support. And then, since then we have, we have three kids that were all born in Singapore. And so obviously we've kind of put a lot of roots here.
Yeah. I think the fact of moving or just having some experiences early on is definitely like life-changing. I'm also from a village, actually 7,000 people. So I found someone
even smaller. Gigantic village.
Yeah, and also when I was 20, I went to Shanghai, and then I went to Hong Kong, and you actually get lost there. And I mean, before going, you're a bit like kind of tripping, like, oh man, I don't know what's going to happen. It's kind of like scary, but exciting at the same time. And then you're there and you're getting lost, but it's so amazing because at the same time, like, especially as a man, nothing can really happen to you. So you're there and like you just learn I'd say like more like to increase your tolerance to stress at the end of the day. Like how do different situations affect me? I've been through that. I've been through the experience of like not even having maybe one for me one time in Hong Kong, I didn't even have a place to sleep at night. So I ended up sleeping in a spa. It was really weird experience, but like super funny at the end of the day. And I realized nothing can happen. I mean, things can happen, but like it's never as bad as you think. And in general, in life, you have these early experiences. You're going to realize later there is always a solution, and actually things that look bad because your brain is wired to get you scared of most things actually. And it's never as bad as you think. And there is always a way to make it work.
I agree. I think the early experiences in managing uncertainty and managing different situations, I do think that helped me become a better problem solver in a way, right? And also judging the extent, the risk you are facing when you look at a specific problem. And as part of it is, as I mentioned, the experiences I briefly touched upon. There was more very young, semi-professional. I mean, I was going to work, quote unquote, but in reality, I don't know how much work I was actually producing. I was 18 years old.
That's not the point.
Yeah, exactly. Yeah. So, but anyway, officially I was going to work, or that was I was trying to do.
On the CV, you can add an experience.
But honestly, I was doing my best. But now I don't know how much value I added, but I was trying to. But that's one. But the other thing also that I did a lot after that. So during my university years and early years as a kind of before I got more stable, I got married, etc., is that I used to travel a lot in my free time. Like I backpacked around Southeast Asia, I backpacked South America multiple times. I went everywhere in Europe just backpacking, and I'm not talking about big budgets. I remember in 2005. I was in Thailand by myself, backpacking in Thailand by myself, and I went to Chiang Mai, which I think was different from what Chiang Mai is today. And I took a train from Bangkok to Chiang Mai, a night train. And I remember that I was worried that somebody would steal my backpack. So I tied the backpack to me on the train as I was sleeping on the train. And then in Chiang Mai, I remember I was spending less than $1 a night for the hostel where I was staying, which is but you know, like you mentioned, I don't think everybody needs to do this, but I think the ability to just live in different conditions and kind of go through different things.
Very flexible.
Yeah, it makes you more flexible, yes.
Absolutely, that's so important. I did the same also, traveling through Asia, spent $1 is it's pretty good. Like I think ours were like $3 or $4. Like the worst room I've ever been in the Philippines in El Nido was like many years ago, $3. But actually you realize I'm a creator who can adapt very quickly, and that's the most important. I can go to super nice hotel, I can still stay in like kind of shit places, but at the end of the day, I can survive and I can thrive and be happy in any of these conditions, as long as they're not maybe too prolonged. And therefore I can leave my McKinsey job or big corporate job and start a company.
Absolutely. No, absolutely. Look, I'll give you a more recent example. So in late 2019, I went to San Francisco for work reasons by myself. And part of the trip, I was sleeping in a hotel paid by a VC company that invited me there. But then I extended the trip by 2-3 days to speak to other venture capitalists. I was in San Francisco, went to Silicon Valley. And San Francisco, I'm sure you heard, is absolutely crazy in terms of prices. And so I was scouting. So when I StashAway started to pay for my accommodation, I ended up staying in, and I wanted to stay central because it makes it easier from a logistics perspective. The best I could find at anything below $250 a night, which is a gigantic amount, as much more than I spend when I travel for work, was a room without a bathroom. And so, I was like, do I spend $200 for a room without a bathroom or $350 for a room with a bathroom? And I was like, you know what?
Do I need the bathroom?
No. So what I did, I wake up very early in the morning so I could. No, but this is stupid. Like obviously, it's not that it's going to change the numbers of StashAway if I spend $150 more, but it's a question of how you think about money, how much value you give to money, and what is acceptable, was not acceptable, and that was just not acceptable.
And this should never change. Actually, even if you make more money, you should say, I'm going to pay more for better experience, but there is so many overpriced things that are often linked maybe with hotels to the brand of the hotel or these things that actually don't make sense. I mean, even if you look at the rents in Singapore now, like you don't really have a choice, but like
tough one. It's a tough one.
But it doesn't make sense. And if you think in terms of actual value, that's very important. Like the value of something should never change, even if your lifestyle or your income or your wealth changes, because the actual value of the thing is still the same.
Yeah. On the other side, what you could, let's talk about rent in Singapore. What you could argue is, okay, there is two different ways of defining value. One is value for you, and one is what the market thinks something is valued at, right? And so, if the market right now thinks that a certain type of apartment is worth, just make up a number, $7,000 a month, and a year ago thought that the same apartment was worth $4,000 a month, you might disagree, and I guess most of us would like to disagree, and most landlords would not disagree. But it is what it is, and therefore, then your choice is, okay, do I pay the extra money? So I think value is a difficult concept, right? So
it is, but I would argue with this thing called kind of geographical arbitrage. Obviously, you're tied to a place because you're building a business, but especially again, a big advantage of having moved a lot is, you say the value is subjective, but actually, it's less and less subjective the more I've been to different places, seen the different lifestyle, the different taxes I pay in different places, the different prices of the different things, the different quality of life I get. And therefore I can assign a value to things and say, I accept to pay for this or not. And if I have the luxury to, then I'll move, which is called geography arbitrage. I'll move because I want to have, I know I can have definitely a better life quality somewhere. No place is perfect. There is trade-offs everywhere, but again, moving a lot, especially early on, like helps you assign values to things.
I definitely agree that actually having the flexibility of the mental flexibility of saying, hey, I'm not tied to a place. I can move. Obviously, it becomes more difficult as you take more responsibilities. You have family,
Absolutely.
you have kids.
Yeah.
In my case, you're building a company. And honestly, I think Singapore is a great place. So it's great to be here. But you're right that I think the flexibility of, for instance, in my case, the flexibility of building a company in Singapore versus being back at, what I guess I would consider home, Italy, I think enabled me to have more opportunities.
Yeah. So you've been to McKinsey, then you've been to, I think, private equity,
Yes.
then you went to Rocket Internet. So I want to say basically consulting. Then you were saying in one of our previous conversations, you were saying you realized people were leaving consulting for private equity. So there was kind of a trend there, something there, which basically you ended up following. And then there was a new trend, which was basically e-commerce and internet and tech, early 2010s, which you ended up also surfing the wave with Zalora and Rocket Internet. And then there was a new trend, which was fintech, with the neobanks and Revolut, Monzo, and even what you're doing now, StashAway's, is definitely tied to fintech. And these trends, they really help people who maybe are not building businesses yet to kind of maximize their career opportunities. Because if you follow the right trend, you're going to be in the right place. You need a bit of luck too, but like kind of right place at the right time for the next trend too. What's the next big trend that you think people who want to maximize their career opportunities should be, next wave they should be catching and surfing now?
So let me maybe tell you two things. So let me answer your question in a second. But before I do that, I actually think about my career choices slightly differently. So you're right that what I mentioned to you is that the way, the reason why at a certain point I started looking into private equity is because I saw a bunch of colleagues at McKinsey that I really liked go into private equity. And so I asked myself, what is it? Maybe I should know what it is. Mm-hmm. And therefore I spent actually, my MBA time trying to understand private equity better. But that's not the reason then I moved. I moved out of McKinsey mostly because I wanted a more entrepreneurial platform. McKinsey is a very large institution. I work in two big offices, Milano, New York. And so those were a bit too kind of not enough entrepreneur. There was not enough space, I thought. And then I joined a small private equity shop. I didn't join KKR. Mm-hmm. I actually decided to go to a small private equity shop because I wanted to have more entrepreneurial opportunities. And so when Rocket Internet came knocking at my door, I was like, okay, that's maybe my chance to be ahead of the curve. If you put this in context, this was in 2011. This was in Italy in 2011. Amazon opened an office in Italy 3 or 4 years later. Mm. So this was pre-Amazon in Italy. Yeah. That's what we're talking about. So it was very early days from an internet perspective from where I was at the time, Italy. And so there was a little bit of this, let me be ahead of the game. And plus there is also the idea that this was actually another step into doing something even more entrepreneurial. So having said that, let me answer your question. What are the new trends? It's a difficult question to answer. I've been historically skeptical of some of the hype in some of the technologies that have been very much talked about in the last few years. While I do, blockchain, I think there is a lot of things that will be impacted, and I see a lot of applications on custody and many other areas. But I thought that there was a bit of overhype in the past. I don't know now where we stand, but I thought it was a bit of overhype.
Now no one gives a shit anymore. Yeah. It's these cycles where everybody goes crazy about the thing and then it's gone. It's gone. Yeah. If you talk about that you are in the industry, like people say they're in finance now. They don't say they're in blockchain.
Oh, okay, crypto. I didn't. Okay. Yeah, no, crypto is different. So also crypto, I was not an early adopter, and honestly, to my mistake, I wish I was, but I obviously I came to the train quite late on the crypto side, and I do see potentially some areas of continued development, but I was also always more among the skeptics rather than among the ones super bullish. I have to say that on the artificial intelligence train, while I do think there is some overhype right now, I actually think that the potential to change many things is incredibly concrete. So to answer your question, I do think that artificial intelligence is a trend that people should consider looking into if they're looking at doing different things.
So it's what does that mean concretely? It's joining a because it's very technical. So it's joining a company. Let's say you do marketing, for example. It's joining a company that is integrating some AI or marketing some AI in their products.
I think it's first of all is working on yourself. Is making sure that you are upskilling yourself. So I was speaking at our own town hall a few weeks ago, and we kind of everybody at StashAway. So this is from marketing to engineering to compliance to customer support, everyone. And what I told everyone is you should spend I told if you are less than 55, which is 100% of people employed at StashAway, you might want to spend a lot of your free time, your evenings, your weekends, trying to make sure that you learn how to use AI to become better at what you do.
Yeah.
That's your first step. And so I think that you need to work on yourself. You need to, I think, make sure you're in a company that embraces change and enables you to learn, enables you to grow, enables you to try new things and maybe do some mistakes here and there. I don't think everybody needs to work in NVIDIA to be in AI, right? So it's not that you need to work at at the people building the chips to actually benefit. I think the power of what's happening with artificial intelligence is the breadth of its potential impact, and therefore there's going to be opportunities in many different areas. And so you just need to make sure that if you want to harness this opportunity, you need to first of all work on yourself, on your skills, and on your openness to these new technologies. And secondly, being in a place that enables you to experiment, to learn, to do stuff.
So it's actually, how can I get much better at my job using AI? And almost every job now can be complemented with AI. You just take ChatGPT 3, 3.5, 4, and you realize, oh man, I didn't realize, but I'm able to be much more efficient in everything I'm doing. So that's the first step, basically. It's that. And then the problem with that's an issue actually. We're saying you need to work in a place that embraces change. If you look at most of the big corporations, like for the moment, what they're doing, they're saying no, you can't use AI because all this data is gonna go everywhere and it's too dangerous, and like they're not it's the same as the cloud. 2014, 15. Oh no, my server's in the cloud. Are you crazy? All my customer data will be. Everything is gonna be in the cloud anyway, and everything is gonna end up with AI anyway.
Yeah, so I think prohibiting the people to use new technology is absolutely crazy. And so if you are working in a company that prohibits you to do that, de facto they are reducing your development, right? And they're potentially making you unemployable in the future, which is something that you need to think about. I mean, that's
so don't take the excuse that your company is prohibiting the usage of AI to not spend your evenings or your weekends on learning this stuff, because I know not everyone has the luxury to say, employer, you don't want to, you're prohibiting me to use AI, therefore I'm going to change. Obviously, a lot of people don't have this luxury to say, I'm just going to change my job, but it's not an excuse to just say, this is not going to happen, because it's actually happening already at a crazy pace.
Absolutely. You use your personal computer and in the weekends, do some experiments, which don't need to be just learn, right? Just put yourself out there, and I think that we're still in the very early phases of this. And AI obviously is not just ChatGPT, is not just obviously it became very, very. It went on the first pages of newspapers recently because of ChatGPT and generative AI, but in reality there is much more happening and much more that has been happening for a long time. And I was speaking to our chief investment officer, Stephanie, couple of weeks ago, and she wrote she's a computer scientist, and she wrote her master thesis in I think 2001, 2002, something like that, at Stanford in artificial intelligence. So
2001,
something like that, 2001, 2002. Yeah. So this is not something that so it's been just a development of many things over a long time, and we actually all of us deal with AI technology in many, many different ways already. Now it's becoming available to all of us. I think that's what actually Gen AI makes it possible, and therefore the potential impact is now more obvious to each of us. So to your question, to your initial question, which is, what is the trend that people should jump on right now? But I don't think that necessarily to maximize your career potential, which to me means making sure you continue to have fun at what you do.
Yeah.
You need to jump on the next technological train. I don't think it's that simple. I think just make sure you're an organization that enables you to have fun, enables you to have responsibilities, enable you to learn, and that's what matters, and that's what will pay off also financially if that's what you're targeting at the end of the day. In terms of trend, I do think that, out of the many, many trends we've been kind of talking about over the last few years, I do think that artificial intelligence is maybe the one that is the broadest potential impact, and therefore is the one that everybody should pay attention to.
Yeah, it's very practical, actually. Even yesterday, I had to write a business plan for one of my businesses, actually, and I was just postponing for weeks. Like, I don't have time to write this business plan. And then I was like, I could go on Upwork or Fiverr, this freelance platform, and just hire someone to write it for me. So they're going to ask me all the right questions. I'm going to answer, and they help me frame the whole thing. And then I just go, business plan AI, and there's these AI softwares where you just answer. They're doing what the dude on or the gal on the Upwork would do. Yeah. But now, it's just, I answer this question. The thing is writing the whole business plan for me with doing analysis of trends. And I'm like, and I paid $19. And my business plan that I thought would take me a week or two, obviously I'm going to have to go through it. And but the chunk, the base is there. It took me 45 minutes. I paid $19 and it's there. And it's just you can apply this to everything, food recipes, sports stuff, probably learning, music, everything. It's crazy. And probably it was already there before, but now we have this much bigger awareness that this is a thing. And therefore we're going to start to think for everything we need to do, we're going to think about, is something using AI already available? And it is. And therefore you're 10 times, 100 times faster and better. So it's the people say now AI is not going to replace you, but someone who knows how to use AI will. And at some point, probably AI is going to replace you, but we're not there yet. But you need to, as you said before, you need to understand that this is your Google search, where people who use Google and use YouTube to understand stuff, put stuff together, had a probably big advantage 10 years ago. Now it's do you know how to use AI to complement and become much better at what you're doing? No, absolutely. And then obviously you cannot trust the answers blindly, and you may need to make it yours. Otherwise it becomes, otherwise you become useless for real, right? And so, it's and what you need to do is you need to add value, and you add value. I mean, in the example you gave, you add value by asking the right questions and directing the software, the AI, to give you certain type of answers, and then editing, refining, fixing, changing. It's what it's a sandwich strategy. You kind of the iteration, the sandwich strategy is a good one. Yes, absolutely. Let's talk about investing. The key topic today. Let's do it. Why is it so important for people? So let's start with the basics, right? Not how to invest and all that. Why is it so important for people to not only save? Because a lot of people don't even save money. They just live paycheck from paycheck. So step number one, I should try to save 10, 20% of my salary every month. Right. Let's make the assumption people understand that. Which, by the way, I think it's 50 or 60% of American people don't even have $500 on their bank account in case there's a problem happening. So it's a crazy statistic. But anyway, let's make people assumption people understand that. Why should people not only save but also invest their hard-earned cash? It's very simple, because if you save, let's say we can do some numbers. If you save $1,000 a month, let's say, so that's $12,000 a year. You do it for 30 years, and you put it under the pillow or in the bank account that gives you de facto 0%. At the end of your 30 years, you have $360,000, which, it's not bad.
If you do the same, but instead of putting it under the pillow or in a bank account, you put it in a diversified balanced portfolio, which on average over the last decades have given something around 6%, let's call it. So 6 to 7%, but let's call it 6. After 30 years, you have $1 million. So the difference between $360,000 and $1 million in terms of, let's call it retirement, it's quite significant. Obviously, you can scale it up. Instead of 1,000, you can make it 2,000 is the difference between 720 and $2 million. And that makes a big difference. Now, we can introduce concepts like inflation.
I want to talk about all that.
Exactly, but that makes the discussion more difficult. I think the simplest way to think about it, forget inflation, irrespective of how much a dollar is worth 30 years from now, it's the difference between having 360
to one more or not,
to 360 or 1 million. That's the difference, right? Yes. Then whether a sandwich costs $5 or $10 or $20, it doesn't matter. You can buy more sandwiches if you have $1 million than if you have $360,000.
Yes.
Now, the more so that's why I want kind of keep it super simple. And I'm using 6%. You can do the math with 5 or 7 or 4.
Yeah.
It's gonna change the number slightly, but the concept remains the same. Over a long period of time, the difference between money that is not working for you and money that is working for you is gigantic.
Yeah.
It's called compounding. And the problem is that you don't see it next month. You don't see it the following month. You don't see it in 5 months from now. You don't see it even in 2 years from now or 3 years from now. That difference compounds over time. And we are wired in a way that we seek instant gratification, and therefore we don't appreciate this compounding effect, and therefore we don't have the intrinsic motivation to actually have this long-term goal and keep at it, yeah. Be constant, be disciplined, etc., etc., etc. It's the same as if you take two 20 years old people, and one of the, they do exactly the same life. And they have these, two twins, let's say. They have exactly the same life, the exact same body shape, etc. The difference is that one of the two doesn't do any exercise at all, and the other one does 10 minutes of exercise every day. 10 minutes every day, nothing.
Nothing, but compounded every day.
After 20 years, they would be completely different people. Absolutely. Completely different people, right? It's only 10 minutes every day, but if you do it every day, discipline for 20 years is going to change you completely. The same happens with money. It compounds. So you want to talk about inflation? We can.
The brain, just regarding compounding, the human brain doesn't understand exponential growth. So therefore, the only way you can do that is either take an Excel spreadsheet and calculate the compounded interest, which is a bit weird, but there's also a lot of compounded interest calculators online or on most of these wealth management platforms. Yeah. And I suspect on StashAway too, like you basically have, if you invest that much at that percentage, look at the growth of your portfolio over time, and you can project yourself. And then there's always this kind of cue or benchmark that you have, and you look at, I know I'm investing every month. Yeah. Because I want to get there one day. Versus and then you need to know that it's not going to be a linear journey, right? So it's not that the markets go up by... That's the next.
So when I say 6% in 30 years... On average. It doesn't mean 6% every year. So 6% a year in 30 years doesn't mean 6% every year, and definitely does not mean 0.5% per month. You're going to have positive months, positive years, negative years, and if you get scared and you try to kind of overthink it, you will potentially actually not make it happen.
Yeah. Let's try to go a bit deeper into that. So now we understood the very, very basics. I still want to go a bit deeper into what we call inflation, and also how it's tied to basically the agenda of the central banks. So it's actually going not only with inflation, but saying, the whole concept of wage deflation, money printing, the fact that asset prices go up, therefore retirement costs more and more because asset prices go up, but wage don't go higher or don't follow. Like this concept basically. So not too long, but at least we understand why is everything becoming more expensive And therefore, why is real estate also becoming more expensive? So if I don't have it, it's becoming expensive. But if I own it, stocks or real estate, I'm beneficiary. But why? How is the system built so that this stuff is actually, so people understand, I'm not just doing a gamble on the future that these companies are going to do well, but actually the entire system is built for these asset prices to go up.
I mean, the way I simply think about it. I mean, first of all, let's start from the concept. What is inflation? Inflation means that positive inflation means that price of goods and services grow over time. Most central banks in the world target an inflation rate at around 2% per annum. So a good assumption to make is that in the next 30 years, you're going to average more or less 2% per annum inflation, right? So if you're thinking about a long term, I mean, this year it's going to be higher, but over the long term, more or less, inflation will probably be 2% because that's what the central banks want, and the central banks actually have the tools to make it happen. What does it mean is that the sandwich that today costs, actually, let's do easier number. What can cost $100? A chair that today costs $100, let's say, next year on average it costs $102. The following year will cost $104.4.
Yeah.
And that compounds similarly to, so it's not plus $2 every year. It's $2 the first year, the second year is $2.4, and that's going to be then $2.8, et cetera, et cetera. So it's going to grow over time, and that will, make your cost of life higher. Now, as you work, most probably your salary will also grow in line with inflation, or if you're making a good career, probably higher than inflation.
Yeah.
I mean, as you get more senior, actually your salary will probably grow faster than inflation. And so you actually become wealthier versus the cost of your life. The issue is that when you stop working and you retire, inflation will continue growing while, your assets that you put together to pay for your retirement are now where they are. And unless you continue working, you're not going to have another inflow of other cash that will continue to grow with inflation. And that's why it's important that you've planned for it way ahead of that, because otherwise it's too late and you're forced to do potentially things you don't want to, because maybe you want to stop working, or maybe you can't work anymore because you are at a certain age and you can't physically do that anymore. And so that's why it's important that you start planning very much in advance. Now, so that's the core basic concept. Now, you were asking.
So just before that, basically it means that, back to our first question, which was, why should you invest and not just keep your money in cash? It's because of this 2% inflation every year, which might be more in the future. We'll see about that. Your purchasing power is just becoming less and less. And again, because if you understand this concept of compounding, $2 this year, next year, 2.4, in 30 years, it's going to be a lot. Yes. And if your money is not working to at least beat this 2% every year, you're getting really screwed. Absolutely. That's the basics.
Absolutely. I would argue that even with 0% inflation, you should still invest, because having $1 million, having
absolutely
more than 3 is better than having 360, irrespective of how much a sandwich costs.
Absolutely.
But you're right, that inflation makes it even more obvious.
Yeah. So now you wanted to add, because now we're talking about, for me, it's basically adding a new concept. I mean, it's not new, but like to this conversation, now that we understood the basics, is since the dawn of times, governments have been, it's getting a bit more complex, but it's very important to understand. I think governments have been funding wars and their expenses and economic crises with money printing from the central banks, and how this is affecting, and we're seeing it now, like, because of what happened in 2020 during COVID, how this is affecting the cost of different things, which not only the food and the rent and all that stuff, that's bad, but that's not the worst. The actual worst is, why do people work? Okay, they want to have fun and they need to be busy and they need to be stimulated, but people work because one day the goal is to retire. What is the definition of retirement? Is either working on something that I love too and I don't need to necessarily make money, or I can just stop working. When central banks, since pretty much forever. And governments, when there is a problem in the economy, because we have a debt-based system, basically. So the system is basically based on a growing debt. When every time there is a problem, the answer to this problem is printing more money, this affects the prices of assets, because the assets are fixed and they're denominated in a value, the dollar, the euro, that is not fixed, that is just being printed, that is less and less valuable. Therefore, the price of these fixed assets, real estate, stocks, crypto, whatever, is going up on average in time, just because there is always more and more money printed. And so therefore, if I'm working all my life to retire, I'm working basically to earn in cash to buy these assets that in the future should cover my life expense at a, let's say, interest rate of 5 or 4% or whatever. If, let's make the assumption I don't have an amazing career where I just like get these better jobs and grow my income a lot. Let's say my income like increases like following inflation, 2%. But then the central bank is printing and printing and printing money, and therefore these asset prices that I need to acquire to one day be able to retire are becoming more and more expensive, because it's what's happening. Why is real estate going up like crazy since forever, or stocks? That's basically what we're trying to get at, like in this conversation, is it's partly because yes, the companies I'm investing in are doing great. That's one thing, but the actual thing is there is so much money printing that if you look in terms of real return and nominal return, I think it was so it's Raoul Pal he was in 2000 since 2010, 2009, since the QE, quantitative easing, after the great financial crisis. He was just saying, let's divide the S&P 500, so stock market, real estate, by the central bank balance sheet, to see whether the growth in this asset is due to good performance or is due to money printing. And basically we're saying, look, so nominal, basically we went up a lot, but in real rates we're kind of flat, meaning that almost none of this growth would be from actual growth, but much more from money printing.
Look, I'm not an economist, and so the economists listening will hopefully accept my apologies in advance for my simplifications. Also, I don't want to go. I'm not going to go too technical because I'm not the right person for that. But obviously, cycles of money printing have an impact on all asset classes, and we saw it in the last few years, right? So it's the 2021, let's call it asset bubble, or kind of market tops across multiple asset classes, was driven by the fact there was a lot of money in circulation, and as soon as the banks started to dry up a little bit, and in order to fight inflation, obviously that has an effect on all most asset classes. In reality, when you look at the stock market today, more or less, I'm looking. Let's look at S&P 500. It's now at around somewhere between 17 and 19 times price earnings. That's the kind of core measure of value right now. So de facto, you're assuming you're going to get a bit more than 5% earnings yield. It's not dividend, but let's call it earnings yield on your equity, assuming no growth, which is more or less the historical standards, and it's a kind of it's not a crazy number, right? So now, obviously, this is a broad number. It doesn't look at all the companies out there. It's not cheap. It's not expensive. It's more or less, the average was 18 times, and now I think it's a bit above that. It's maybe 19 right now, driven mostly by the famous 6 or 7 companies.
Yeah.
And so,
regarding that, I saw this morning a chart, or yesterday, that was saying this year, I think this year the market is up. So US market is up 11%. If you take out these top 7 companies, you're basically flat at zero.
Yes. Yeah. No. Exactly. So, but no. Exactly. So it's incredibly narrow right now. But forget for a second. This is something that happened in the last 6 months. But in general, I don't think that the message is that increase of prices of assets over time is driven by some sort of financial manipulation or excessive money printing. Money printing has an effect on markets and on asset prices for sure. Depending on expected returns in different asset classes, you're going to see money moving from one place to another. And so, for instance, this year we're starting to see more and more money moving to short-term government bonds because 2 years ago they were giving 0, now US giving 5%, Singapore's giving 3.5%, etc. And probably starting to see now more kind of a slightly longer term bonds attracting capital as well. But this is simply natural movements of investment trying to get the best returns, and I think it's fair and it's kind of good behavior of the market. Are there bubbles out there? For sure. I mean, there are bubbles, and I do think that there is some overhype on AI, for instance. I mean, I said earlier I do think AI will have a gigantic impact. I do think that some of the AI valuations out there don't make sense to me, at least. But and we will continue to see bubbles, and this is something that will continue to happen. You're going to have periods of overexcitement versus a certain topic, and then you're going to have the opposite, the underexcitement about other topics, which is why I always go back to the same mantra, which is it's very difficult to get it always right, to always know which are the 6 companies that are driven the returns. That you mentioned this year 7 companies made all of the returns of the S&P 500.
Yeah.
And if you only invested in those 7, you would have made, I don't know the number, but 40-50%, something like that. If you invested in the S&P, you made around 8 or 10 or something like that. Because you probably don't know which ones are going to be the next 7 in the next 6 months, you're better off always diversifying and invest in the S&P if you're just looking at the US markets. My perspective, you should be looking at global markets, and you should not be looking just at equities, but also bonds, etc., etc. So, diversification is honestly the answer to all of these questions.
So now we understood why we should invest. Basically, do you want $1 million or do you want 360K in 30 years? To make it simple, you need to invest your cash because you want more money in the future. Let's talk about the principle of investing. So the principles, there's a few principles that are very important because people will ask, okay, and I understood why. Oh, I'm just saving, and I'm actually thinking about my girlfriend. She's just saving money. She's like, I have 6 figures on my bank account. I'm like, so now
I have a solution for her.
We'll talk about it later. We're getting there. So, so she's going to ask, how do I do that? What do I need to understand? And so just before we start the conversation, like a few principles, I'll just recommend 4 books that I read that I think are amazing to start my journey. The first one is called Unshakable by Tony Robbins. Yep. That is basically a summary of a bigger book that I also read that is also amazing called Money Master the Game. The third book is The Little Common Sense of Investing by John Bogle, the founder of Vanguard. And the 4th book is called A Random Walk Down Wall Street by Burton Malkiel. And all these books basically say the same thing. So probably you can read 2 of them, but it's just like you want to read maybe 2 or 3 different authors to realize, it's actually always the same. Yeah. Because everybody's saying the same, and everybody who's been making a lot of money has been applying the same very kind of boring principles, which we'll talk about right now. So Michele, you're building a very successful business around those principles, basically, and around making it easy for people to invest. So can you spill the beans and tell us what are the few key principles that new investors need to understand if they want to apply their financial goals, to reach their financial goals?
Yeah, so look, the way I thought about it for myself, and I couldn't find a solution that helped me, and that's why I started building StashAway, is quite simple. what you need to do is, as you mentioned, you need to invest. First of all, you shouldn't just be out. You need to diversify. So you shouldn't bet in a single company or even a single segment or a single sector or a single country. So you need to diversify it across asset classes, depending on your risk level, but you don't want to have probably equities and bonds and gold and real estate, and I'll talk about risk in a second. You want to diversify across geographies. All of us have what is called a home bias.
Yeah.
So if you talk to British people, they'll have excessive investment in the UK. Americans have excessive investment in America. Singaporeans have excessive investment in Singapore. It's normal and it's wrong. So kind of diversify geographically is important as well. Diversify across sectors and themes, let's call it, just more broadly. So diversification is very important. You also need to diversify across times. You don't want to time the market. And that's why the best way to do it is what people call dollar cost averaging, which is in practice means that you decide that every 22nd of the month or 3rd of the month or 14th of the month, whatever your favorite number is, you invest whatever your monthly saving is, $100, $1,000, $10,000, $1 million every month in that diversified portfolio. And you do it for a very long period of time. So you are gonna, when the markets are higher, you're gonna end up buying a few less assets. When the markets are lower, you actually buy more. They're on discount, so it's better. But you don't try to predict what's going to happen, because anyway you're going to get it 1 time right and 3 times wrong. And so it's a useless, expensive, complex, and not good use of your time.
Maybe something to add to that is, actually you said it would be the 16th, the 22nd, and the 3rd. When most people, I think, should try to automate that first. Okay. Like you need to, so first you need to pay yourself first. What does that mean? It means that as soon as you receive your salary, let's say it's on the 25th, the first thing you do is this 10 or 20% that you want to invest, you invest them right away, and then you leave the rest of your month with the remaining money. If you do it later on, you're not going to invest.
I agree.
And you should automate that. And then you can even have like your employer match some chunk of that, depending on like what scheme you're under. Because if you automate it, it's going to be done automatically, obviously. And if you do it right after receiving salary, then you're gonna do it.
Yeah, and you know how much you can spend.
Yeah,
because that's what's left in your bank account.
Yeah,
when you're spending. And actually, the idea of having a spending account and kind of separated with your kind of investments, which includes maybe your emergency funds, by the way, which should not be your spending account. Your spending account, your emergency fund should not be the same account, because then it becomes tricky. So anyway, going back to what I was saying earlier, diversify, dollar cost average, which de facto is diversify time as well. And maybe the third principle, or maybe the first one, is make sure you're investing at the right risk level. And why it's so important is because if you're taking too little risk, let's say, you're not maximizing the value of your money over time. And if you're taking too much risk, you will end up stopping your plan. There is going to be one day where you're not going to sleep at night because your portfolio is down more than you can support because you took too much risk, and you're going to sell everything at the worst possible moment.
Yeah.
And so that's why it's so important that you take the right risk level. Now, what is the right risk level? It depends from 2 factors. One is timeline. Yeah. The more time you have, the more risk you can take. So for your retirement plan in 30 years, you can take more risk. For your, I want to buy a house in 2 years' time, you need to take much, much, much less risk because you only have 2 years to go. So more time, more risk, less time, less risk, first. And second, personal preferences. There is people that can sleep very well at night, even when their portfolio are down a lot. Let's use crypto numbers for a second. You might be down, 85%, and some people can still sleep at night. And people that when they start seeing red in their investment portfolio, they can't sleep at night. And And so it's important to recognize and acknowledge the situation and take into consideration. So diversify time, so dollar cost average. Make sure you're taking the right risk level, because that's what was going to prepare you to go through the ups and downs.
Yeah.
And embrace those ups and downs. You know, if you are in your 30s and you think you're going to retire 30 years from now, but that's true also if it's 20 years or 15, but let's use 30 just as an example. In the next 30 years, most likely you're going to go through 5 or 6 bear markets and 20 plus corrections. That's a fact.
Bear market is more than 20% correction, and
yeah, bear market is when the markets go down by more than 20%, and correction is when the market goes down between 10 and 20%.
Okay,
so that's the usual definition. So this is going to happen in the next 30 years. There's going to be probably 5 to 6 bear markets and probably 20 plus corrections. That's a fact of life. You cannot go around it. Don't even try to time it. You might get it once right and 24 times wrong, or twice right and 23 times wrong.
Yeah.
And so what you need to do is you need to prepare to go through these corrections, and you look at them with the right mindset. And the right mindset, exactly. The right mindset is actually, if you have your standing instruction or your e-gyro set up where you invest on a monthly basis and the markets are down, that month you're actually buying more than in the previous month where the price were higher. So when you look at it from the eyes of the future, you're actually making your best investments when the markets are down, not your worst investments.
Yeah.
Then the problem is that we are wired to look at it with the eyes of the past, not the eyes of the future. There is a beautiful quote on this from Warren Buffett that says, imagine you are driving a car and you have 1/3 of your, your fuel is 1/3 full, 2/3 empty. And you're driving past a gas station, and the gas station says, price minus 50%. I say, wow, this is great. You drive in and you fill your tank, right? You put the 2/3 on because it's cheap. You're happy. If you're early in your investment career, and therefore your investment tank is 1/3 full and 2/3 empty, because your earning potential is much higher than what you earned so far, you're going to invest more in the future than you invested in the past. And you have more time, ahead of you, and the markets are down, let's use the same number, 50%, you should, use the same logic. You should be happy because you're fueling the tank at a lower price for future benefits. It's honestly, obviously very difficult as a human being to grasp this. It's just against all of our biases, but it's the right way to think about it.
So in the Unshakable, I think, the book, one of the things that struck, and I read it many years ago, one of the chapter is called Tax, Fees, and Fear. So the thing is, what are the things you control in investing? You don't control the markets, what they're doing. But there's 3 things you control. Taxes, which is going to be very easy for us because, we're in Singapore, so it's much better for people. There's no capital gain taxes, there's no tax on dividend, etc. Fear, you just talk about it, like risk profile, to make sure that you can stomach these bear markets or these up and down. And the last one is fees. Do you want to talk more about how important the fees are and how the entire financial industry is built to extract as many fees as possible and to sell you products that are not in your favor? And that's also based on your personal stories. Maybe you want to when you started to invest, you said people were...
Yes. Let me start from why it's important. Let me use the numbers again. So let's say that you invest $2,000 a month for 30 years. And actually 2 different people, both investing $2,000 a month for 30 years. Both of them investing in portfolios that return 6% per annum before fees. Same risk, same sophistication, same intelligence, same returns. 6% per annum gross of fees. One of them pays fees that are typical of mutual funds or unit trust in Singapore. So the assumption here is that they will pay 2.5% entry fees every 2 years. I'm generous here because on average people churn every year. So I'm saying every 2 years. And then around 1.5% per annum. Again, I'm generous here because on equity products is actually 1.8, 1.9. So one of them pays 2.5% every 2 years, churning product, and 1.5% per annum on everything. That's more or less what you end up paying all in if you are investing through kind of a unit trust structure. Then we can talk about the different products, but that's kind of your more or less your baseline if you invest with a bank. The other one pays I use the StashAway number because I have the StashAway numbers in mind. But anyway, our fees, which starts from 0.8%, they go down to 0.2% as your portfolio grows larger. So on average, during this journey, you probably end up paying 0.3, 0.4. I don't have the exact number, but the numbers are doing right. At the end of the 30 years, remember, same return, 6%, 6%. At the end of the 30 years, the first guy, the one paying the bank's fees, will have $1.2 million. The second guy will have $1.8 million. The only difference has been fees.
Yeah.
Now, the difference between 1.8 and $1.2 million, which is 50% more, 50% more, $600,000 is the difference between a retirement where you watch a lot of TV and a retirement where you go to Paris once a year, or you go to Tokyo once a year, or you go to Seoul once a year.
Or let's be even more extreme. Is the difference between one where you're basically worried if you're going to die, if you're going to run out of funds before you die.
Yeah.
Which is a catastrophe, but it's happening to a lot of people. Or one where you just basically have and the one where you worry, you're probably not retiring. You have to work longer because you don't know. Whereas the other one, you have a great retirement. So it's changing everything.
Absolutely.
Or one where you could say, actually, I don't want to retire at 65. I can retire at 60 or at 58. Whereas the other, you need to work longer. So it's a massive difference of just making a different decision on who I invest with and what fees, the difference of the fees. Why? Because these fees compound over time, the same as the interest. Correct. Except they work against you.
Exactly. So it's not that you paid $600,000 more in fees. It's that the fees you paid early on, they're not in your investment account any longer, and so they don't compound for you any longer, and therefore reduce your total amount at the end. Now, this is not the worst of the problems, though. So this is why it's so important. The worst of the problem to me is that the typical fee structure in most of the investment industry creates a series of misalignment of incentives.
Completely.
So if the person that is talking to you about investments makes money at the end of the month personally, makes the bonus, makes the career, etc. If he or she sells you products that make more money to the bank or the institution the person is working for
than for you,
obviously, and for good reasons. I mean, this is not being a bad person. This is just, this is a problem of incentives. For good reason, this person will when decided between showing you product A that gives to the bank, 1%, and product B that gives to the bank 1.2%, which one do you think they're going to show you or promote you a bit more? Obviously, product B. Are you 100% sure that they're going to show you product B because they think, in all honesty, that product B is better for you than product A? Maybe sometimes you have that alignment of logics, but in most cases, at least the question mark remains there. So, and this misalignment of incentives over time reduces the efficiency of your investments, not just on the cost side, but also on. So the assumption before was having the same 6% gross returns. Here I'm telling you, actually, in reality, probably you're also going to leave money on the table on the sophistication side because the system is just built in a way that doesn't incentivize the person on the other side of the table to actually help you, make sure that you make money over time.
So what you're saying is that your financial advisor in your classic bank doesn't have your life as a priority.
But and
I'll give you an example.
I don't want to make it personal though. So it's not a financial advice. It's not a fault of the relationship manager or the private banker. It's just that the incentive system is built that way.
Yeah.
It's not their fault.
So, and that's the difference between what we call these mutual funds and these ETFs. So two things regarding that. First one is, again, these books that I read, and kind of like the statistic is, when you start to investing, what do I invest? There's thousands of products. There's what we call actively managed products, which is people say, I'll buy and sell and I'll beat the market. I'll do better than something where you just buy the average market, which is the difference between a mutual fund and an ETF. An ETF is basically buying the market. To make it very simple, 96% of these mutual funds that are managed by people do not beat the market. So you're overpaying to underperform the market. That's the first thing. And the second thing that I actually learned a few weeks ago, talking to one of my financial advisor friends, who is a really good friend of mine, he actually told me, and this I was like, I knew it was bad, but I didn't think it was that bad. He told me, bro, I'm in town for 2 weeks because I need to make money. I'm like, how do you make? I know financial advisors make really good money. The principle is, I find someone who has, let's say, $1 million to buy a certain product. And he's telling me, actually, let's say 1 million, for example, could be 5, could be 100K. Whatever. One out of the 1 million that I get from my client that I invest for him or her, 10% of that, so 100,000, is locked in for 10 years. Because the company that is providing this product knows that within 10 years, they're going to be able to do certain performance just with this 10%, I'm able, as a financial advisor, to get 5 to 10% of the whole 1 million, so 50 to 100K upfront like that. That's my commission. I get 10%. And then he says, obviously, I never tell this to any of my clients or prospects because they would never give me their money if they know that there is directly 10% of the whole amount that goes into my pocket and that is not invested in the future. But that's what's happening. So, I mean, it's pretty clear, right? The finance industry is very opaque with a lot of kind of wording and difficult terms and everything. But it's because the entire financial industry makes money out of all these people who just don't understand what to do. And they know, I need someone, I'll give you my money because I trust you, because you're a banker, you have a nice suit and you have a nice tie. And
so the products you mentioned, so those are typically insurance products. So these are ILPs, whole life, universal life endowments, where either you have a one lump sum immediately, you invest in $1 million or $100,000, lock it in for a very long time, or you have a commitment to invest a certain amount of money every month for a very long time. These type of products, because they have very long lockups, they give incredibly generous commissions on day zero to the salesperson, the relation manager, the bank, either the institution or the person, depending on the structure. And again, and the fees that are, if you look at the fee structure of these products, which are usually very difficult to understand, even if you read the prospectus, they are stupidly high, like, somewhere between 2 and 3% per annum, which is a gigantic, I mean, it's more than the numbers I gave you, I used for the example earlier. And so that's in fact one of the other products that actually gets sold a lot for this reason.
One thing in their defense is they're often also able to create some tax structure for the clients that might come from another country, and in the long term you might be able to say, but at least that's how they feel better about the whole thing. But nonetheless, very important to understand that the fees that often we don't even really know what we're paying, and like it's all hidden and everything, and that most of the industry is not incentivized to help you out, and therefore you are the one who gets screwed because you're going to have to work longer or you'll be more stressed during your retirement. So that's why you should think about low fees and go for these cheaper options or products like ETFs or what you guys basically are doing at StashAway.
Yeah, but look, and you were talking earlier about active versus passive, and so you're right. And when you look at the statistics, you quoted a number, I guess, from Spiva, showing that active managers actually underperform the market on average, 95% over the last 15 years or something like that. So a gigantic number. The way we think about it is that it's now proven over the last 2 decades that security selection doesn't pay off its costs. What does it mean? When you think about investments, you have two steps. The first one is I have $100 and I need to decide how much of these $100 to put in equities, stocks, how much in bonds, how much in real estate, how much in gold, et cetera, et cetera. Let's say that you decided to put 10% in North American equities. That's your asset allocation decision. So now you know that you're going to have $10 for North American equities. The next step is security selection. I have $10 to invest in North American equities. Do I invest in Amazon, in Google, in Microsoft, in General Motors, in Tesla, et cetera, et cetera? That's security selection. So the statistics you quoted earlier shows that security selection, so the process of actively deciding whether to invest in one company or another, doesn't pay off. Like professionals doing it as a job, over the last 95% of professionals doing it as a job in the last 20 years actually underperform the index, the market, okay? And that's why we strongly believe, and not just us, all the books you mentioned actually say the same thing, in investing in what are called passive instruments, ETFs or index funds. So, investing in, again, ETFs being the most easy ones because they are traded as a stock. They're passive. They simply buy the market. They buy the S&P 500. They buy the tech sector of the US. They buy the global bond index, et cetera, et cetera, et cetera. Now, where there is impact to be made is on the asset allocation side. Depending on different studies, BlackRock says 80%, Vanguard says 94% of the difference in returns between different investment portfolios is driven by asset allocation. So the decision of having 10% gold versus 15 versus 0 is much more important than the decision to invest your North American equities allocation to Amazon, Google, or Tesla. And that's why we believe, I personally believe, and that's why StashAway is also built this way, that it does make sense to actually spend time crafting an asset allocation that is, first of all, coherent with the risk you should be taking for that specific goal. We talked about the risk earlier. And secondly, that is optimized over time, not every day, over time, slowly, for changes in the macro environment and in the market environment. In 2022, you wanted more inflation protection. In 2023, you want a portfolio that start to leverage some of the higher yield you have in the market with treasuries, that you have some defensive positioning in case, in fact, the economy goes into a recession, still maintain some inflation protection. 2024, we'll see. So things change over time. You want to, over time, dynamically adjust your positioning.
I mean, the next question is very logical, and we kind of understand it after everything we've talked about. Why did you build StashAway? What is it, and why did you build it?
So I started StashAway with two other people, Nino and Freddy, my two co-founders. In 2016, we started. And the short answer to your question is that the idea came from me and came from the fact that I was extremely pissed off with the banks. At the time, I was the CEO of a company. I was decently paid. I was saving money. I started to accumulate cash in the bank, similarly to your girlfriend.
So CEO of Zalora, accumulating cash in the bank and not really knowing what to do with that.
No, I knew what to do because I have a background in finance. So I knew what to do. I didn't have time.
Yeah.
And, I have two kids at the time and a wife and a fairly demanding job. And so I just wanted
to not be good.
Kind of, exactly. Yeah. I just wanted to do something right?
Yeah.
So I wanted to feel good with myself. And I had two young kids. So I was in a phase where I was like, okay, I need to make sure that I take care of them, right?
Yeah.
So I had a little bit of money suddenly became something a bit more important than, I had, my daughter was actually recently born and my son was 2 years old. So it was very, very young kids. And as I was starting to think about, okay, I need to be responsible. I guess that was the real thinking. I need to be responsible. And I wasn't, because cash in the bank, I knew was a mistake, as we discussed earlier. And so I went to the two banks I was banking with. I'm not going to name them, but, two very large banks.
There's not many large banks in Singapore.
No, one Singaporean, one international, very large banks. I went to the two relationship managers and I told them, hey, I'd like to invest in a portfolio of ETFs on a monthly basis. Because that's what I used to do when I was back in Italy with very little money when I was younger. So I was like, I know what I want to do. I used to do it. So I just want to do it again. And I said, I want to do it automatically every month, forever, in a portfolio of ETFs. And both relationship managers told me, yeah, I cannot help you with that. But if you want, I can sell you these beautiful mutual funds or unit trust or these insurance products.
So that's where you see
or the structured notes. Yes, because
the problem of incentives.
Of course,
they cannot even help you.
Of course, because they make zero commissions on ETFs. Zero commissions on ETF. So I didn't know at the time. I didn't understand it at the time. Now I know it very well. At the time, I didn't fully understand it. But they make zero commission ETFs. So they told me, if you want to buy ETFs, you can do it on the bank's platform. You need to do it by yourself. So I actually looked into it, and then it was impossible to automate it. The fees were stupid, and the platform was built in the 60s. Crazy. And so I was like, okay, this is not going to work for me. And these are, the two banks acted exactly the same way. They keep pitching me the same three products, all of them. Unit trust, insurance products like ILPs, and structured notes. And recently more structured notes than anything else. Again, structured notes, they make a gigantic amounts of fees, and they don't need to tell you because they're actually margins, not fees. And so they, it's just, they risk rewards imbalance is gigantic. Anyway, so that's where I was, right? And so I had this cash in the bank. I was incredibly angry with the banks. And then one day in April 2016, I found out about the existence of digital investment managers, or robo-advisors, as people like to call them. I don't like it, but that's a name that used to be used a lot. In the US. And the way I found it is that the largest shareholder of Zalora, a Swedish company called Kinnevik, led a funding round in the largest robo-advisor in the US, Betterment. Yeah. And so this landed on my desk because I used to check their reports, the Kinnevik reports, and I read about it. I was like, okay, fully digital, ETFs based, low cost. And I was like, haha. That's where I want to invest my money. Yeah. So I went on Google and I wrote robo-advisor Singapore, thinking, let me find a local player, I'll invest there. And I couldn't find any.
Nothing. Yeah.
And that's when I said, maybe I should go back to my original finance roots. Remember my in a career started in finance, and that's what I should be doing. And that's when I look for co-founders. I met first Nino, our CTO, then Freddie, our chairman of the investment committee. And when I found Nino, close to 2 decades of experience building tech companies, and then Freddie, more than 2 decades of experience in investing billions of dollars for institutional investors, I thought there's not going to be anyone that can build such a complementary experienced team. And that's how we started.
That's how the best companies are built, by solving a problem that you experience yourself and you're very frustrated about, and then finding a way to scale it to the masses. And that was absolutely needed for everyone. And then there is just the education part. Like, people need to get educated and understand. But that's why the first part of this podcast was all about, kind of trying to educate people on why they should invest, and then how, and then there is platforms here, because even these few simple principles we talked about before, it's still like, for someone who's it's too much. So like, I want something that I can just put my money, is just going to invest every month for me. And I know they have my best interest at heart in the long term, because the person who built that or who started that actually had all these frustrations, and instead of complaining, basically said, I'm going to solve my own problem and then make this available to other people.
But in fact, one of the brand DNA tagline that we used to use internally in the early days was, we want to build the investment service we want for ourselves. Yeah. That was the way we discussed it internally. And in fact, all of my money is invested with StashAway. My wife also has an account with all of her kind of a personal spare cash, because that's the way
so all of your money that you're investing for a retirement account, anything, is all on StashAway.
all of my financial investments are with StashAway.
Wow, amazing. So pretty much all of my friends are on StashAway, basically, which shows that.
That's good to hear.
I was saying, I'm
them.
having Michele on the podcast, and we're like, I know StashAway, I'm using it. But some of them are not happy.
Yes.
Why are they not happy? For something you don't control, which is the markets. So how do you deal with people? Because people want to use a platform like StashAway because it makes things much easier and you don't have to think too much about it. But at the same time, the less you want to think about this stuff, the less you are kind of educated, the less you are patient with these markets. And we've been kind of trained for the last 10 years, 12 years before COVID, and even after COVID like that. It's just an up-only mode. How do you deal with people who are not happy and complaining because, I'm down 20% on my money this year? And when is my money coming back up? Like, should I just use another platform because they do better?
No, it's a good question. So look, as we discussed a couple of times earlier, right? So a long investment journey will go through ups and downs. And let's use the same example as before. If you have a 30 years time horizon, you're going to go through 5 or 6 bear markets. We just went through one, and through 20 correction. We went through one in Q4 2018. Since we launched in July 2017. So since we launched, we had a Q4 2018 correction.
Yeah.
We had obviously a super sharp correction. You can call it a bear market, but I was so sure that honestly, I'll call it a correction in March 2020.
Yeah.
And then we went actually through a bear markets over the last few quarters. So this is what happened over the last 6 years. So it's coherent with what I said. In 30 years, expect 20-ish corrections and 4 to 6, 5 to 6 bear markets. How do we deal with it? And in talking to our clients, since the early days, so when the markets are going well, we've always told clients there will be ups and downs. Don't get overly excited when things are up. Don't get overly depressed when things are down. Continue investing, dollar cost average. We have e-gyro solutions, so you can actually completely automate it. And that's the right way to do it. First. Second, make sure you have the right risk level. Because when things go well, you will feel, I should take more risk. Yeah. Why? Because if I took more risk, I would have made 8% this year instead of 6%. Fair. But then when March 2020 happens, and the portfolio makes minus 12% in a month, and the other one makes minus 14 or 15% in a month, that makes a significant difference. And then also the speed of rebound is different, right? And so making sure you have the right risk level that enables you to feel right and to feel you're doing the right thing, even through the ups and downs, is incredibly important. Now, what we offer is extremely diversified. We manage the asset allocation dynamically, and over time we've done well. So since we launched in July 2017, so we have a bunch of portfolios. But if you look at the kind of the core, it's 12 portfolios. We have also a few other products, but the 12 core portfolios, the majority of them have actually overperformed the benchmark. Quite significant.
I was about to ask that. Okay.
Yeah. So the majority of them have overperformed the benchmark. There is the higher risk ones that have not, and there are 2 reasons for that. One is that we launched them later, and so they didn't benefit from the earlier. So we launched those products around a year and a half later after the first one, and so they had less time. And the second one is that they had a China technology allocation in 2021 that actually depressed the returns in 2021. So, looking back, obviously, that actually has depressed the investment during that year, and that was kind of an asset allocation imperfection during the year, which depressed returns. But it's now, if you look at it with a 3 years, 4 years time frame, so since inception, let's call it, we actually more or less at benchmark. So last year the higher risk portfolios have overperformed benchmark by more than 5 points, and so we have continued to do quite well. What do I say to your friends? It's a long term game, as I mentioned earlier.
Buy more, continue investing now, because if you're down, you're gonna be able to buy a bigger chunk than in the future, and therefore you're gonna do better in the future. And now is basically not the moment to take your money out. I mean, basically taking your money out is like the worst thing you could do.
Yeah, but in general,
you're going to screw this compounding.
But my general message is even more simple. It's not even about continue investing when the markets are down and stop investing when the markets are high, or withdraw when the markets are high. I think my main message is don't continue. So if you continue to believe that you're doing the right thing, and so in practice what you started, which was investing in a diversified portfolios with the idea of doing it for a long time systematically, and you still believe that's the right thing, keep doing it. It will pay off. I keep doing it irrespective of markets. Markets are up or down. It doesn't matter. You keep doing it and you do it for a very long period of time. That's the right thing to do. And it will give you your expected returns over time. So if you have a high risk level, you're going to land at your, somewhere between 8 and 10% per annum over time. If you have a low risk level, you'll land at, 4 to 5% over time. You just need to give it time.
Absolutely. So someone now understood all these principles and they say, I'll use StashAway because I'm based in Singapore, in Southeast Asia, or I think even you're also in MENA. You've started in Dubai or...
Yeah, we are in Singapore, Malaysia, Thailand, Hong Kong, and Dubai, UAE.
Yeah.
Being there means we are licensed in each of these 5 markets. So in reality, you can open an account even if you live in Italy. Yeah. You can open a Singapore account.
Yeah.
But we're not licensed in Italy and we don't have a bank account in Italy. You need to send the money to Singapore.
Okay.
While in each of these 5 markets, we accept local money and we are licensed locally.
So kind of to wrap up today, I want to invest, but because we need to wrap up, you said like, how are we going to talk that long? But it's actually already over.
I'm shocked.
And there is so much more we could talk about.
I'm shocked.
We're going to do another episode too about AI and all this stuff, education, all the stuff we want to talk about. Anyway, so to wrap up this episode, I want to start investing, but I'm scared because recessions and crash and everybody's scared and I have a lump sum. What do? I have 50K to invest now. So it's not as easy as saying,
yes,
I'm going to start investing 10% of my salary every month. What do I do?
It's a good question. So the short answer is it depends on how big of amount it is for you. It's 50K, 100% of your net worth, or is 1% of your net worth?
Yeah.
I'll give you my specific case. When we went live with StashAway in July 2017, all of my money was in cash.
Yeah.
And that was everything I had.
Yeah.
And so what I did is I set up a 24 months monthly plan.
Okay.
Where, I took my cash divided by 24, and every month, 1/24 of that cash was going to get invested into the diversified portfolio. I had a few portfolios for different reasons.
Yeah. Time diversification, basically.
Yeah, exactly. Now, looking back, actually, it would have been better if I invested everything on day one because the markets went up. Because the markets went up over the time. But looking back is too easy, and on a risk-adjusted basis, it was the right thing to do. And so, I did 24 months because this was everything I had. So to answer your question, if it's 100% of what you have, I would take a long time. Let's call it 24 months, 20, 30, and do it in installments over a period of time. If it's 2% of your net worth, you can do it in a month or in 2 months or in 3 months. Or another way to do it, and this is, I heard some people that are trying to, this is a little bit of time in the business. It goes a bit against my not time in the market principle, but I heard a few people doing this and say, hey, I have a lump sum. I have a 20 months or 24 months schedule, but if the markets go down by more than 5%, I put 2 months instead of 1.
Double, okay.
I double. Yeah. If it goes down by 10%, I triple or quadruple. If you go down by 15%, so in practice, you shorten your period. You're going to get fully invested faster because you are kind of speeding up your time to market. Again, it goes a little bit against the time to market, but it's a principle I could live with.
Yeah, it requires a lot of discipline, actually, both. Because you could, like you say, I have 24 months, I'm going to invest every month, 1/24th, but everything is going up. At some point, you could FOMO in and just say, fuck it, I'm just going to put everything because the thing is going up nonstop. So you need to keep disciplined. Or you say, I'm going to double the amount if it goes down. The problem is, like, psychology will tell you if it goes down, it's going to go down even more. Therefore, I'm not going to invest double. I'm going to invest single, or I'm going to invest nothing. I'm going to invest four times as much when it goes even more. And then you end up like missing the dip. So it's very difficult.
Which is why I think my suggestion, if you want to do this, is actually write it down. Like, hold yourself accountable.
Yeah.
But anyway, the short answer is invest monthly, even in these cases. Like you can actually use the logic of dollar cost averaging and diversifying time risk, even if you have a lump sum.
Amazing. Thank you so much for your time, Michele. And thank you so much for what you're doing for people in APAC and in MENA, because this is so important. And this is so important because there's a big problem since forever with this kind of finance industry and education and the new technologies and the internet, and making people understanding that this stuff is actually not that difficult, especially with these platforms, and that this thing, the earlier you start, the bigger impact it's going to have on your retirement. It's so important.
Absolutely. I agree. Thank you for having me.
Thank you so much.
Thanks.